Is Canada okay? 2.8 million for that. So a decent chunk of my viewers are from outside of Canada, mostly from the US, and I get a lot of comments saying things like, oh, Canada is just as bad as the US, or Canada is getting almost as bad as the US right now. And the situation in Canada is actually substantially worse than the US right now, and I can show it to you with data. And this is not a competition, it's just to provide some context for my other satirical videos. This chart is from financialsamurai.com, which is a very good finance blog that's been around for almost 15 years, and he was kind enough to let me use this in my video. This shows the increase in home prices over time in red versus the increase in income over time in gray. You can see here a peak in prices right before the 2008 financial crisis, and then there's a few years of decline, and then prices have been increasing faster than income for the past 10 years. That means if you live in the US and you're in your 20s, you've basically been seeing housing prices go up faster than your income for your entire adult life. And that is bad, and I don't want to minimize the struggle that young people in the US have had, but let me show you the same chart for Canada. This is what the trend in home prices looks like in Canada. We're not just in a housing bubble now, we're in the same bubble that the US was in 15 years ago that's still going on today in Canada. See, we had a peak here at the same time as the US, but then prices just kept going up and up and up after that. So what's going on here? I'm not an expert, but I'll tell you what I think. In Canada, a lot of people view even their primary residence as an investment rather than as a place to live, and a lot of people are banking on the value in their home as their retirement plan. They don't have enough cash saved up to retire, but their plan is to sell their home, downsize, and use all of that equity to fund their retirement. And that has made our governments at all levels and in all parties very, very afraid to let home prices drop. And every time it looks like housing prices might drop, they respond by giving people access to more debt. And they say this is to make housing more affordable, but actually it just continues to drive prices upward. 15 years ago, they changed mortgage insurance rules to allow banks to give longer mortgages to people with less money. And these mortgages were insured by the taxpayers, so banks could make money without taking on any risk. After that, we had over a decade of record low interest rates, which led to Canadians taking on record levels of household debt, which creates a lot of risk if interest rates rise. And now, interest rates are rising, and the government is making a Hail Mary attempt to save the situation by changing mortgage rules again. Normally in Canada, a mortgage is 25 years long, and if your interest rate goes up, your payments go up. But instead, they're allowing banks to keep the payment the same and increase the length of the mortgage. This is someone with a variable rate mortgage whose interest rate tripled in a year. And the length of their mortgage increased to 72.5 years, but the payment stays the same, which means they're going to be paying 3 times as much overall for the same house. Now obviously this is not sustainable, and eventually the whole thing's going to have to come crashing down. But no government wants to be the one in the hot seat when it finally does, so they're going to try and keep it going for as long as they can. Kristen the Realtor says that most of the reason behind Canada's prices are because 50% is the GTA. This is skewed. I got a lot of comments like this saying that it's only Toronto and Vancouver that are inflated and the rest of Canada is fine. First of all, saying that it only looks like we're in a bubble because so much of our population lives in a place where there is a bubble is kind of a weird argument. And second, anyone who lives outside of Toronto and Vancouver knows that house prices have been inflating everywhere, especially in the last few years. Now, I don't really need to show you 20 separate graphs to demonstrate this, but I do have 20 separate graphs to show you. If you'd like to check today's data, it all comes from the Canadian Real Estate Association's Home Price Index tool. CREA data starts in 2005, so keep in mind we're only going to be seeing about 18 years of data versus almost 50 in the last chart. And all of my use of the data falls under fair dealing, so don't even start with me about that. Let's start with the provinces. Here we have Alberta, Saskatchewan, British Columbia, Quebec, Ontario, Prince Edward Island, New Brunswick, Newfoundland and Labrador, Nova Scotia. For some reason there's no Manitoba composite, but here's Winnipeg. And speaking of individual cities, Montreal, Halifax, Moncton, Kingston, Cambridge, Bancroft, Tillsonburg, Sault Ste. Marie, the BC Interior, North Bay. And the realtor who posted this comment is from Niagara, where prices tripled in just 6 years between 2016 and 2022. You're a realtor in Niagara. I know you've seen this data, so don't talk to me like you haven't. Yes, Toronto and Vancouver are the most inflated, but that doesn't mean that the rest of Canada is normal. You can say it's just Vancouver and the GTA until you're blue in the face, but everyone can see that that's not what's happening. So just stop it. So I got a few comments asking about the 72-year mortgage that I showed in my first housing bubble chat video, including a mortgage broker that says what I was saying was incorrect. And you know what? Fair enough. I had to leave out a lot of important details because the video is only 3 minutes long and I can't go into everything when I'm trying to make a different point. To be clear, I do already know about mortgage rules, including terms and renewals and rework. But in my opinion, the more you know, the worse it gets. So let's get into it. This person has what's known as a variable rate fixed payment mortgage, which means that if interest rates go up, the bank charges you more interest, but your payment stays the same. So more of your payment is going to interest and less is going to paying down the loan. So 72.5 years is how long it would take this person to pay down their existing mortgage at their existing payment. But will they actually be paying down this mortgage for the next 72 years? Under the current rules, no. When they reach the end of their mortgage term, usually 5 years, they'll have to renew with a new payment amount and schedule. Because interest rates have gone up, they'll have to increase their payment, and under the current rules, they'll also have the option to extend their amortization to 25 or 30 years depending on how much equity they have in the home. So what would that actually look like? I made this mortgage calculator spreadsheet so I could back calculate some details about their mortgage based on the info on the bill. Right now they've got just under $1.3 million in debt left, and they're a little less than 4 years into the mortgage, assuming this is a 25-year amortization. At their current interest rate, almost 98% of their payment is going to interest, so when they renew next year, they'll only have a little bit less debt. If they want to keep their schedule the same and pay down their mortgage over the next 20 years, they're going to have to increase their payment to over $8,700 a month. But if they can't afford that, they could extend their amortization out to 30 years past the renewal date, and their payment would be about $7,150 a month. That means they'd be paying over $1,300 a month extra just to set themselves back 10 years on their mortgage, and they're only 4 years in now. It also means they're going to be paying about $1.2 million more in interest over the course of the mortgage than they had initially planned for. To be clear, this is also a concern for fixed-rate mortgages that are coming up for renewal. Unlike in the US, where you can get a fixed rate for the entire length of your mortgage, in Canada it's only fixed for a certain term, usually 5 years. So anyone who bought near the peak with low rates and now is renewing is still going to see a big hike in their payments. I'm starting to run out of time for this video, so I'm sorry, but I'm going to have to split it into 2 parts, but I'll post them back to back in the playlist so you don't have to wait to watch the next one. And don't worry, it gets worse. In the last video I talked about that 72-year mortgage and how it's not really 72 years, but the person is still going to be paying a lot more for a lot longer. But now let's talk about how these variable rate fixed payment mortgages apply to the broader Canadian market. The Bank of Canada estimates that these type of mortgages make up about a quarter of all the mortgages in Canada. They've been getting more popular in recent years because they have lower initial rates, which lets you qualify for a bigger mortgage, which lets you bid more on a house. And surprisingly, this person, who would need over 72 years to pay down their mortgage at their current payment, is actually doing better than most of the people with this type of mortgage. When your interest rate rises so much that your monthly payment only covers the interest and doesn't actually pay down the loan, that's called the trigger rate. When you exceed your trigger rate, what happens next depends on the lender. You might have to increase your payment, or they might just take the extra interest and tack it onto your principal. So you still make your payments every month, but the amount that you owe is going up and up and up. 6 months ago in October, the Bank of Canada estimated that 50% of these mortgages, or 13% of all the mortgages in Canada, had already reached their trigger rate, and that by the middle of this year, that number would be up to 65%, or about 1/6 of all the mortgages in Canada. So 1/6 of all mortgages in Canada are either not being paid down at all, or are actually increasing their debt over time. And many of these people already maxed out the monthly payment they could afford in order to buy a house at the peak. Under normal circumstances, this would push a lot of homes onto the market through forced sales after defaults and foreclosures. And this would lead to a drop in prices because new buyers coming in with new mortgages wouldn't be able to borrow as much, so they wouldn't be able to bid up the prices of the houses as much as they have in the past. The people who bought at the peak would lose money, the banks might lose some money, but prices would have to fall. But in the latest budget, the government has announced that they're going to loosen mortgage rules again in order to prevent foreclosures. This means more options at renewal for existing mortgage holders, including longer amortizations. They haven't announced what the new rules will be yet, but it's pretty likely that they're going to allow longer amortizations for everybody, including people with high ratio mortgages. Especially because home prices fell over 15% in the last year, which means that a lot of people who bought at the peak might not have that much equity in their home to rely on. This means that people will be able to keep their homes, but they won't be able to afford to move to a new place with a new mortgage, so they'll be stuck paying banks more interest for a lot longer. The new rules will help to keep prices high and inventory low, which is why I'm skeptical when the government calls it a housing affordability measure. They're not really making housing more affordable because they're not doing anything to change the supply and demand in the market. They're just infusing more cash into the buyer side through looser mortgage rules. That doesn't make housing any more affordable for people trying to get into the market. It just sets a price floor and keeps prices from dropping to protect people who are already in the market. The people who benefit the most from this aren't individual homeowners. It's people who have a lot of wealth tied up in residential real estate. That generally means multiple property owners, landlords, and people who treat housing as an investment. But by protecting those owners, you're making it harder and harder for young people to get into the market. Canadian housing bubble. Today I want to talk to you about price speculation. In my last video, I gave an example of a Toronto investment condo and showed how it couldn't possibly be profitable at current prices and rent. But I also got a lot of comments asking why I didn't take price appreciation into account in my calculations. And I didn't do that because the entire point I'm trying to make is that the condo is already overvalued at its current price. My contention is that we're already in a speculative bubble, and that any further price appreciation would just be based on speculation and not the actual underlying value of the asset. And this is the key difference between speculation and actual value-based investing. With any investment, whether it's real estate or a capital asset like, say, a truck or camera equipment or something that you can use for a business, or even stocks, the underlying value is the benefit that you can get by owning it. With real estate, the main 2 things you can do are occupy it or rent it out. You can also improve it, but that's basically just to make it more desirable to live in or rent out. So if you're buying it as an investment, you should be able to rent it at a rate that gives you a decent return on investment for the amount of money that you've invested. But as I showed in the last video, even if you're ignoring the mortgage and saying you own the property outright, the return on investment that you get is about 2.7%, and that's being generous. That's assuming no insurance costs, very low maintenance costs, no vacancy, no special assessments by the condo board, no destructive tenants, etc., etc. If everything goes perfectly, you are yielding 2.7% on a risky, completely illiquid, completely undiversified asset. You could get a better return right now by putting your money in a high-interest savings account. Or you could put it into a safe, boring dividend ETF and make even more money that would be taxed at a much lower rate than rental income. So the question I'm asking you is, why would somebody pay you more money for something that's already a bad investment? Imagine applying this type of thinking to any other kind of investment. Let's say you have a friend who opens up a hamburger store, and every month it's losing $1,000. They're not growing sales, they're not improving their product, they're not acquiring more inventory or equipment, they're just consistently losing money every month. And you might say to them, hey, this is kind of a bad business, you're not making any money and you don't seem to have any prospect of ever making any money. And they say to you, no, I'm actually making money because the value of my business is going up by more than $1,000 every month because businesses always go up in value. That would seem like completely insane delusional reasoning. Generally speaking, nobody's going to pay you a huge amount of money for a business that's not making money and doesn't seem like it's ever going to make money. Although there have been some notable exceptions. And yet, a lot of people have trouble understanding this with real estate because we have a very strong cultural idea that housing always goes up in value, that renting is throwing your money away, and that owning is always better than renting. But if you break down the numbers, you can see that's actually not true. Sometimes renting is cheaper than owning. And house prices can go down. When the last Toronto housing bubble popped in 1989, prices declined for 7 years and took 20 years to recover to their previous high. So the point is, if you can't make money by owning your investment and you're just banking on somebody else to pay you more for your already bad investment, that's not investing, that's just speculating. 2.7% ROI in this example is better than a 0% yield on a non-dividend paying stock or crypto. Both depend on price appreciation. This comment is in reference to my garbage math and price speculation videos, and if you haven't seen those, you can watch them in the playlist if you want some more context. I have been trying for over a month now to explain the difference between investing and price speculation. And I've been trying my best to do it in a way that you don't need any background in finance or real estate or investing in order to understand it. And yet, there are still quite a few people who don't really seem to understand what I'm saying. What I've been saying is that when your investment is supported by fundamentals, the price of an asset is going to be directly connected to the yield that you can get by owning that asset. For example, if you were looking at two investments of the same type, and one of them pays you $1,000 a year, and the other one pays you $2,000 a year, logically, the one that pays $2,000 should be worth about twice as much as the one that pays $1,000. And for every type of investment, there's usually a ratio of yield to price that's considered reasonable. In general, when you have to put forward more capital or take on more risk or put in more work, you would expect a higher return on investment. Now, 2.7% on a rental property is really bad because rental properties involve a lot of capital outlay, a lot of risk, and a lot of work that you have to put in to manage it. For reference, you can currently get a better return by putting your money in a high-interest savings account, which involves no work and carries almost no risk. With Toronto condos, on the other hand, people are not so much worried about the money that they can make renting it as they are about the amount of money that they can make by selling it after the price goes up. But if the return on investment for your investment property is already really low, it doesn't make sense for prices to go up on a fundamental basis. That's why my opinion is that investors in the Toronto condo market are engaging in price speculation rather than investing. Now, he also mentioned that stocks that don't pay dividends or crypto have no yield without price appreciation. For crypto, I agree, that's completely speculative. But this seems to be a complete misunderstanding of what stocks actually are. Stocks are not just numbers that move up and down on a chart. When you own stocks, you own a piece of a company, and companies do things that make money. So when you're evaluating the price of a stock, it's important to look at the earnings, or the price to earnings ratio. If a company is turning a reasonable amount of profit for the stock price, then it doesn't really matter whether or not they're paying dividends. If they're making money but not paying it out in dividends, it means that they're reinvesting into the company or building up cash reserves. And in both of those situations, it's reasonable to expect price appreciation because there has been a material change in the assets of the company. Similarly, if you have a profitable rental property and then you take that money and reinvest it into improvements in the property, then there would be a reason to expect price appreciation from that. But if you have an unprofitable company or an unprofitable rental property and you're banking on somebody paying you more for it later, that's price speculation. This is really not that hard of a concept to understand, but we have such a strong cultural belief that real estate can only go up that people will jump through all sorts of mental hoops to believe that real estate is a great investment no matter what, even when the fundamentals tell you that it's absolutely not. And that cultural expectation, I think, is a big part of why there's so much price speculation right now to begin with. And frankly, I think the only way we're going to get out of that is if we collectively stop believing in the cult of real estate as a bulletproof investment. I wasn't going to respond to any more comments on my garbage math videos, but this one just dovetails in so perfectly with some stuff that I want to talk about in my next amateur landlord video that I couldn't resist. Basically, this guy posted to let me know what a genius investor he was for buying a house in 2007 with a 5% down payment. And this goes into something called attribution bias. Now, this is a big topic, but part of it is that people tend to believe that their success is due to their own efforts and any failures are due to external factors, but not the other way around. This guy bought in 2007 when interest rates on mortgages were falling to record lows. In fact, since 1990, the Bank of Canada's interest rate has been falling pretty steadily, and up until last year, it was close to zero. And when interest rates go down, house prices go up because you can borrow more money for the same monthly payment. Now, some people complain that my spreadsheet doesn't account for the benefits of leverage because in Canada, you only need a 5% down payment, which means you can be leveraged 20 to 1 when you buy a house. That means if prices go up, you make a lot more money than you put in. First of all, my spreadsheet does take leverage into account. Watch the videos. Go look at the spreadsheet. And second, leverage goes both ways. If prices go down, you stand to lose a lot of money very quickly. And since last year, interest rates have been going up. Also over the past year, prices have gone down by 12.3%. So imagine you buy a house for $500,000 with a 5% down payment. Let's look at a couple of scenarios. And to keep the math simple, I'm going to ignore mortgage repayment and mortgage insurance premiums for high ratio mortgages because it doesn't matter for the point that I'm trying to make. Just try to focus. When you buy the house, you now own an asset worth $500,000. You've paid $25,000 out of pocket and you owe $475,000. Everything's even. Now, imagine prices go up by 10%. You own a house that's worth $550,000, you owe $475,000, and you only paid $25,000. You've tripled your money. Great job. But let's say you bought last year with the same down payment. Now, you've paid $25,000, you own a house worth $438,500, and you still owe $475,000. That means you've lost all the money you put in, plus another $36,500. On top of that, mortgage rates have gone up from about 1.5% to 4.5%. So if you've got a variable rate mortgage or you're renewing a fixed rate mortgage, the cost to carry that debt has gone from about $7,000 a year to over $21,000. Now, I'm not like a big math guy or nothing, but looking at this, it kind of seems bad. It certainly doesn't seem good. And this is why I keep trying to explain where value in an investment comes from and how it's different from price speculation. Because interest rates were declining for 30 years since the last housing crash, we have almost no cultural memory of anything but debt getting cheaper and housing going up. In fact, I've had people my age look at this and ask me when I think interest rates are going back down to normal. Now that interest rates have hit rock bottom and are going back up, there's no fundamental reason to expect huge price increases going forward. And if you think there is, try making your own video explaining it, because anecdotes about how you bought a house 15 years ago and the price went up aren't really that convincing of an argument. I've been talking about the Canadian housing bubble for a while, but now I want to take a step back and look at how we got here. Unlike most people, I don't think there's any one explanation or solution, but I do think one of the major factors in price increases is that we've had a long period of cheap debt for mortgages, and that's caused a significant bubble in real estate valuations. I'm going to start with why cheap debt pushes house prices up, and then I'm going to get into what's happened over the last 15 years and what has changed recently. If you already understand why cheap interest rates push house prices up, you can just skip ahead to the heavy-duty spreadsheet stuff later in the video. To start off, a really important factor here is that the actual price of a house has become a completely abstract concept to people in Canada these days. People don't really have an idea of what $500,000 or $800,000 really means, they just look at the monthly payment on the mortgage. You see this way of thinking pushed all the time by people in the real estate industry, as well as just ordinary people trying to justify a price. They'll tell you to look at a mortgage payment versus your monthly rent, and remember that mortgages build equity, but rent doesn't. So for almost everyone, the monthly payment is what matters, not the price. And this is why I've been saying that home prices are strongly affected by interest rates. At a lower interest rate, you can borrow more money, so all else being equal, you'd be willing to pay a higher price for the same house. Say, for example, you can afford a monthly payment of $2,000. Over a 25-year mortgage, you'll make 300 monthly payments for a total of $600,000. At a 2% interest rate, about $127,000 of that money goes to interest, and $473,000 goes to paying down the loan. That also means that at this interest rate, $473,000 is the amount that you can afford to borrow because that's how much you'll pay off over the length of the loan. At a 7% interest rate, $311,000 goes to interest and only $289,000 goes to principal. So when interest rates go up, you can't borrow as much money for the same monthly payment. This chart shows the amount you can borrow with a $2,000 payment at different interest rates. At an interest rate of 10%, you could borrow about $228,000. At 6%, you could borrow $315,000. And at 1.5%, you could borrow just over $500,000. So, assuming you can afford the down payment, you might be willing to pay drastically different amounts for the same house at different interest rates, even if your income and monthly budget was the same. On the flip side, if you had, say, a $400,000 mortgage on a $500,000 home, this is what your monthly payments would look like at different interest rates. At 1.5%, you'd be paying $1,600 a month, but at 6%, you'd be paying over $2,500 a month. So for house prices to stay the same when interest rates have increased so much, it's equivalent to almost a 60% increase in the cost of buying a home. As I said before, over the past few decades, interest rates have been consistently going down over time until just recently. So, how does this affect house prices? To figure it out, I use the data on discounted 5-year mortgage rates from RateHub because the actual rates offered to borrowers tend to be a little bit lower than what's posted by the banks. Then I took a payment of $2,000 a month in July 2008 dollars, which is 15 years before the most recent data, and adjusted it based on the Consumer Price Index. Basically, paying $2,000 a month 15 years ago is roughly the same as paying $2,700 a month today. Then I took the historical interest rates and the monthly payment and ran it through the mortgage formula to figure out how much you could afford to borrow on that equivalent monthly payment on a 25-year mortgage. Basically, I'm calculating your effective borrowing power at an equivalent monthly payment over the years because I'm going to be comparing it to a home price index which is not adjusted for inflation. So, this is what that would look like. If you had $2,000 a month in 2008 money, this is how much you could borrow on a 25-year mortgage over time. You can see that your borrowing power basically doubles from $300K to $600K before falling back below $500K after the recent rate hikes. Now, it doesn't really matter if you have $2,000 a month or $1,000 or $3,000, the proportional effect is the same. So I took that data and converted it to an index where July 2008 is the baseline of 100. It's the same curve, it's just made into a general comparison instead of a specific dollar amount. And the reason I'm doing this is so that I can compare it to the Terranet House Price Index, which is a benchmark house price index. That means we're making an apples-to-apples comparison of how the same house changes in value over time. It's important to do that because over time, new build houses have gotten bigger and more luxurious on average, which has also pushed up the average price more because you're not buying the same product, which is a separate problem that I'm not going to talk about in this video. I'm trying to isolate the effect that cheap debt has had on house prices, which is why I'm using a benchmark index. So this is what that looks like. As you can see, the curves for borrowing power and home prices track each other pretty closely up until the last couple of years. There's an obvious increase in home prices over time, but it's mostly been supported by general inflation and the availability of cheap debt. However, you can see that recently there's been a really rapid divergence of house prices versus the amount people can borrow for a mortgage. To show the combined effect a little more clearly, I converted it to a ratio of the home price index divided by the borrowing power index. You can see that there's a slow but obvious increase in house prices over a decade or so, but a lot of the price increase is supported by cheap mortgages. In fact, in 2021, when rates were at rock bottom, there was a point where you could actually get an equivalent house for the equivalent monthly payment of 15 years ago. But then you can see that things go absolutely crazy in the last couple of years. You'll also notice this area of the charts that I've highlighted because this is something I've talked about in the beginning of the end video that I made a while ago. That highlighted section is the period of time when we had a massive increase in the number of people taking variable rate mortgages. At the time, interest rates on variable rate mortgages were a little lower, which meant that you could get more money for a lower monthly payment compared to a fixed rate mortgage. And this is the same time that rates were rising and house prices were rapidly diverging from borrowing power, which puts those people in an extremely risky position. And that brings us back to something I've discussed many times, which is how people are really bad at evaluating risk in real estate because they think it's an invincible investment. Even though most people only think about the monthly payment, the actual price still really matters. When rates are falling and prices are going up, everyone who's already bought has a great time because they're making money and their debt is getting cheaper. But if rates go up and prices fall, you don't owe any less money than you did before, but the amount you're paying to borrow it is getting higher and higher, even if the price of your house decreases. And 2 years ago, when rates were at rock bottom, they really only had one direction they could go, so people who bought based only on a monthly payment may have gotten themselves into real trouble now that rates have gone up significantly. So despite how much people like to talk about supply and demand, there's been a massive decrease in the amount of money available on the demand side, which means that unless interest rates go back down quickly or incomes rise very quickly, there's going to be a lot of downward pressure on prices. And frankly, it doesn't seem like rates are going to plummet anytime soon, and I don't think anyone is expecting a massive increase in average income. Like I've said before, none of this means housing is suddenly going to become more affordable because there's still a supply shortage and debt is getting more expensive. But it does seem like there's a significant risk of a drop in valuations as borrowers get more stressed by interest rates, particularly as more and more fixed rate loans come up for renewal over the next few years. Obviously, lots of people have been talking about the housing bubble for many years now, but in the last year and a half, interest rates returning to historical norms has caused a lot of things to start going completely haywire really quickly, and it's hard to see how this is going to somehow be sustainable. Anyway, that's all for today, but make sure to tune in next time when I'll be talking about how the government may be trying to sneak in a subsidy for property owners by screwing around with the underlying mechanisms of how mortgages are financed in Canada. I also want to say thanks to Joseph, Tristan, and Catherine, as well as everyone else who's supporting the videos. Thanks for watching, and I'll see you next time. The Canadian housing bubble may be on the verge of coming to an end, and it's because of rising interest rates. This is probably the most important video in this series so far, and so I'm expecting it to get almost no views. But this is what inspired me to start making these videos after over a decade of watching the market. So if you want to know what I'm concerned about, this is the one to watch. Before we get started, keep in mind that almost everything I'm about to tell you is not a prediction about the future or speculation. I'm describing things that have either already happened or that are happening right now. It's been covered a little bit in the news, but not in a very detailed way, so very few people are aware of what's going on. Now, there's going to be a lot of details and math in this video, and maybe another spreadsheet. But I'll try to make it easy to understand, and I promise that the longer you watch, the worse it gets. First, a little background. Since the 2008 financial crisis, central banks have been offering extremely low interest rates in order to stimulate investment. But this also has a major inflationary effect on the prices of real assets like houses because it's cheaper to borrow money to buy them. In Canada, we had over a decade of record low interest rates, with the central bank's policy rate never going over 2%. This has led to Canadian households taking on record levels of debt because carrying debt was so cheap. Our average household debt to income ratio rose to over 180%, mostly because of mortgage debt. We recently hit another new record at 185%, and keep in mind that's an average. There's a lot of households out there with no debt, and that means there's a lot of other households out there with several times their income in debt. We've also taken on a huge amount of debt relative to the size of our economy. For reference, when the US bubble burst 15 years ago, their household debt to GDP ratio was 100%. In Canada, we've been over the 100% mark for the last 7 years. This has made us extremely vulnerable to rises in interest rates, because as soon as interest rates go up, it becomes a lot more expensive to carry all that debt. This has been the risk for the last 10 years, and it's only been getting bigger and bigger over time. And now, interest rates are going up. In March of 2022, the Bank of Canada started raising their policy interest rate in order to combat inflation. Over the past year and a half, they've raised the interest rate from 0.25% to 5%, and this has a big impact on mortgage rates. The people who are most affected by this in the short term are people with variable mortgage rates. Now, I've had a lot of people in the comments saying, but variable rate mortgages aren't that common. Who's getting a variable rate mortgage? And over the past few years, the shocking answer to that question is most people in Canada. In 2021 and 2022, when house prices were peaking, over half of all new mortgages were variable rate. And most of those are variable rate fixed payment mortgages, which means that if interest rates go up, you pay more interest, but your payment stays the same. So more of it goes to interest and less of it goes to paying down the loan. In part 5 of this series, I talked about the trigger rate for this type of mortgage, which is the interest rate where you're no longer paying down your principal at all and all of your payment is going to interest. And if you exceed that rate, then there's more interest going back onto the balance of your loan every month. And this report from National Bank estimates that 73 to 80% of those variable mortgages originating from 2020 to 2022 have now hit their trigger rate. And keep in mind, this report was published in January, and there have been 2 more rate hikes since then. Also, home prices are down about 12% from the peak, so at the same time these people's mortgage rates are rising, their equity is getting wiped out. Now, obviously that all sounds very concerning, but it's also very abstract, so I wanted to show you what this looks like in real life. And how am I going to explain it to you? Obviously I made another spreadsheet. What else did you possibly think I was going to do? Here we're looking at an example of someone who bought a house in January of 2022 for $750,000. They put a 10% down payment on a mortgage at 1.5% interest. Their mortgage rate is going to go up in line with the bank's interest rate hikes, and the property valuation will follow the actual national home price index. I'm looking at a 3-year term here, so for everything after the present, I hold the home price index and the interest rate steady. First, let's look at a variable rate variable payment mortgage. As you can see, their payment goes from $2,700 a month to over $4,300 a month, and because of the way mortgage amortization works, more of their money is going towards interest and less is going towards principal every month. We also see that the drop in home prices erodes almost all of their equity until a bounce back this year. However, they are still paying off the mortgage. They spent just under $145,000 on mortgage payments, and a little over $46,000 of that went to principal repayment. So it's not great, but if they manage to cover those higher payments, they will pay down the mortgage eventually. But it gets worse. Most variable mortgages in Canada aren't variable payment. They're fixed payment. So let's take a look at that scenario. As you see here, the payment stays steady at $2,700 a month, but in November of 2022, they passed their trigger rate, and the interest charges are higher than the payment every month. And as you can see, their principal repayment goes negative, and they're actually losing hundreds of dollars against the principal every month. So over the course of this 3-year term, their home equity is eroded to almost nothing, and their principal repayment is actually slightly negative. They paid almost $100,000 in mortgage payments, but their loan balance has actually increased by $1,200. They also only have about $2,400 in home equity left. So they basically lost their entire down payment, they spent another $100,000 on the mortgage, but they actually owe more than they did 3 years ago. And that's before accounting for any other costs like taxes, maintenance, and insurance. But don't worry, it gets worse. The real trouble starts at renewal. When this person qualified for a mortgage, they qualified at a stress test interest rate of 5.25%. That means at that interest rate, they would be paying the highest amount that the bank considers them reasonably capable of paying, which is about $4,000 a month. However, their rate is now 6.25%, which is going to translate to a payment of about $46.50 a month. Now, assuming they're with a federally regulated lender like a bank, they won't need to requalify, and they won't be denied a renewal as long as they've been making their mortgage payments on time. And as long as they can keep making the new payments at $46.50 a month, they can keep the mortgage. But that new payment is $650 a month higher than they were assessed as being reasonably able to afford, and it's 72% higher than the $2,700 a month they were planning on paying. Another option would be to make a lump sum payment at renewal to reduce their monthly payments going forward. But to get their monthly payment down to that $4,000 that they're reasonably able to afford, they would have to put down a lump sum payment of $95,000. And if they only had $70,000 to put down in the first place, how likely is it that they have another $95,000 to put in, especially when their payments are about to skyrocket? There's another potential problem they're going to face at renewal, which is that if they want to refinance, the stress test rate is going to be even higher, something like 8%. And unless they've had a big increase in income or a big reduction in other debts, they're not going to qualify for a new mortgage. That means they're pretty much going to be stuck with whatever rate their current lender decides to give them. Alternatively, they could go to an unregulated lender, which tends to have more flexible terms up front, but won't offer them the same protections that they would have with a regulated mortgage. The fact of the matter is, no matter how you approach it, this person's going to be paying a lot more in interest than they initially planned for, and it's going to be enormously financially stressful. People in this situation are in serious trouble. And a lot of mortgage brokers and lenders are now going into triage mode and just trying to find solutions to keep people from being forced to sell their homes. However, if people are forced to sell right now, they'll be selling into a market where prices have dropped and people have substantially less borrowing power to play with. It's entirely possible that people will be selling at a loss, and if they're underwater on the mortgage, meaning that they owe more than the house is worth, the situation is even worse. People often say that when you have a mortgage, you don't own the house, the bank does. But the actual situation is more precarious. You own the house and you owe the bank whatever you paid for it, even if prices drop. Almost all mortgages in Canada are recourse loans, meaning that if the bank doesn't recover everything you owe them from the sale of the house, they can come after your other assets for the rest. Unlike in the US crisis, people can't just give up the house and walk away from the debt. In Canada, if you're forced to sell when you're underwater, you could not only lose the house and all the money you put into it, but some of your other savings as well. Now so far, we've only talked about variable rate mortgages, but in Canada, fixed rate mortgages will be coming up for renewal as well. And in recent years, only about 20 to 25% of mortgages were fixed for 5 years or more. The rest are shorter term. So while variable mortgage holders are the leading edge of the problem, we're going to be seeing these fixed rate mortgages come up for renewal from now until about 2027. And if rates don't come back down, those people are also going to be under a lot more financial stress. And our core measures of inflation, even excluding housing, are still plateauing above the 2% inflation target. So it's entirely possible the bank will continue to hike interest rates if they consider it necessary to hit the 2% inflation target. So if interest rates stay where they are or continue to increase, we're going to see a lot of households having all of their income vacuumed up by interest payments. That's bad for the economy, and more importantly, it's bad for people who are trying to lead happy, fulfilling lives. Because they're going to be selling a lot of the productive years of their life to the bank, all because they were convinced that real estate is a great investment at any price. And that's important to keep in mind here. We're not just talking about numbers, we're talking about people. The unfortunate thing is, this needed to happen sooner or later, and it was always going to be a painful process. People can't just take on more and more debt forever and never expect any kind of correction. And delaying this process for so many years has only made things worse and worse. Now, this doesn't necessarily mean we're going to see the bubble burst and have a sharp decline in prices. But with a lot of people no longer able to afford the houses that they already own, it's hard to see how we're going to sustain our current prices, let alone big increases in prices going forward. That's it for today, but stay tuned for next time when I'm going to be talking about the impact of cheap debt and how we got here in the first place. I also want to thank everyone who's been watching, as well as Hannah, Jessica, and Flavio for supporting the channel. It means a lot to me that people think listening to me yammer about this kind of stuff is worth their time, let alone any kind of money. Thanks again, and I'll see you next time. In my last video, I talked about how most mortgages in Canada are recourse loans, which means that if you default on your mortgage and the sale of your home doesn't cover the amount that you owe, then they can come after your other assets for the rest. And I had a couple of people comment that in my example, I used a 10% down payment, which means that it would be an insured mortgage, and they asked, wouldn't this person be protected by mortgage default insurance? And the short answer is no. And like I keep saying, the more you know, the worse it gets. So let's get into it. The key thing to understand here is that mortgage default insurance doesn't protect the borrower, it protects the lender. And don't take my word for it, you should look it up because it's important to know this. Basically, if you have a high ratio mortgage, it's a higher risk loan, and the bank doesn't want to lose money if you default on the mortgage. So the bank buys mortgage default insurance, which means that if you default on the mortgage but they can't recover all the money that they're owed from the sale of the house, then they can get the rest of the money from the insurer. The insurer also doesn't want to lose money, which is why insured mortgages are recourse loans. And that means you're still responsible for the loan even if the sale of the house doesn't cover the full amount. And again, you can verify all this for yourself. As an example, here's the CMHC's FAQ on mortgage loan insurance. Now, a lot of borrowers seem to think that they have mortgage default insurance that protects them. And the reason for this is that when they got the mortgage, they would have been charged a fee for mortgage insurance. And the reason for this is that banks don't want to lose money on the loan, so they get insurance, but they also don't want to pay for the insurance, so they pass those premiums on to you. And they do you the favor of just rolling those fees into your mortgage principal and charging you interest on them. So, the bank is protected by default insurance, and the insurer is protected by requiring that the bank makes it a recourse loan. The only way the insurer is really going to lose any money is if the borrower is forced to declare bankruptcy and they don't have enough unprotected assets to cover the balance on the loan. Now, there are a few types of assets that are protected in bankruptcy, most notably money that's in an RRSP and has been there for at least a year. If you have money set aside for retirement in a registered account or plan and it's been there for at least a year, it's not eligible money for creditors to go after. Of course, as you may know already, our government, in their infinite wisdom, has a plan that allows people to borrow money from their RRSP to pay for the down payment on a home. Like I said, the more you know, the worse it gets. Every time I talk about the housing bubble in Canada and how it may be coming to an end, I get dozens of comments about how prices can't possibly go down or even that we're not in a bubble because of supply and demand. Supply and demand, supply and demand, supply and demand. Every time. And in terms of the real assets side of things, as in actual houses and the people who want to buy them, they're right, this doesn't affect supply and demand. But I've been talking about the monetary side of things, as in interest rates, the cost of money, and money supply, and all of that affects prices. Now, to understand what I mean about money supply, we're going to have to get into a little bit of macroeconomics, but don't worry, I'm not going to go super deep right away. I'm going to ease into it slowly so you can actually enjoy it. We'll start off with a concrete example of a mortgage, and then later in the video we'll get into how money is created and how it affects the supply of money in the whole economy. Let's look at someone who can spend $2,000 a month on a mortgage payment. At a 1.5% interest rate, they'd be able to get a mortgage for just over $500,000 on a 25-year term. However, if you raise the interest rate in line with the Bank of Canada's interest rate hikes, then you'd only be able to get a mortgage for a little over $300,000, which is a 38.5% reduction in their borrowing power. To look at it another way, if they wanted the same amount of mortgage debt at the new interest rate, they would need a payment of about $3,250 a month, which is a 62.5% increase in their monthly payment. So for home prices to stay where they are right now is actually equivalent to a massive increase in valuation, because the cost of money and borrowing money is getting so much more expensive. This may seem like a weird concept, but money doesn't have a fixed inherent value. Money and things have a value that is relative to one another. When interest rates go up, it makes money more expensive and it reduces the supply of money. And when money gets more expensive, the amount of money that people are willing to pay for things should go down to compensate, as per supply and demand. And this is the reason why the Bank of Canada uses interest rates to try to control inflation. Now, to start to wrap your head around the idea of money supply, you have to understand how money is created. A lot of people think of printing money like a guy with an old-timey printing press and a pork pie hat handing out sheets of freshly printed currency to kids on the street. Now listen here, sonny, you go get yourself a stick and you go get yourself a hoop and you meet back here and you push the hoop down the street with the stick because that's what boys your age seem to like these days. In reality, it's pretty boring and doesn't involve that much character work. Money is created through the banking system. Most countries in the world operate on a system called fractional reserve banking, which just means that when you deposit money in a bank, they don't have to keep all of your money at the bank, they can lend some of it out to other people. They only really need to keep enough money at the bank to facilitate day-to-day transactions. To make the math simple, let's say the bank has a reserve requirement of 10%. So if you deposit $100 at the bank, they can take $90 of it and lend it out to someone who wants to buy beans. Then the guy from the bean store can deposit that $90 at his bank and they can lend out $81 to someone who wants to buy bread. The baker takes that money to her bank and they lend out $72.90 to someone who wants to buy beach umbrellas, and so on and so forth. If you follow this example all the way down the rabbit hole to infinity, then you can theoretically create about $9.50 of new money for every dollar in the original deposit. Now in Canada, we actually have no reserve requirement. If you deposit $100 at a bank, they can theoretically lend out all of it. Instead, we control the money supply through the central bank's interest rate. The exact details aren't important for this video, but just understand that when interest rates go down, people are incentivized to borrow more, so the overall amount of money in the economy increases faster. On the other hand, when interest rates go up, people are incentivized to borrow less, and so money creation slows down. However, if you look at our data on the money supply in the overall economy, there's some pretty unusual stuff happening. In 2020, interest rates went down to rock bottom, and we were borrowing a lot of money, and the government was borrowing a lot of money for us and throwing it into the economy. This resulted in the money supply growing a lot faster than usual, which resulted in rapid price inflation. So, last year to try to get inflation back on track, they started raising interest rates really rapidly, and now money creation has gone negative. That may not sound like a big deal, but this dataset goes back to 1996, and this is the only time that that's happened in over 25 years. This is why I'm not really interested in comments saying that, oh, people have been saying this for 10 or 15 years. The things I'm talking about here are recent changes, and they have no precedent in the last 10 or 15 or 25 years. In fact, the last time that we saw the money supply rapidly inflate and then go negative was in the late 80s and early 90s, which was also the last time that we had a major correction in the housing market. And by the way, I haven't been saying that the bubble is going to burst for the last 10 years. I don't even really think it's going to burst now. What I've been saying for the past several years is that there's a lot of risk in the housing market and in the economy because Canadians hold an incredible amount of debt, and if interest rates go up, it's going to cause a lot of problems. And interest rates started going up over a year before I made my first video. Like I said a couple of videos back, the things I'm saying are not even predictions. I am just describing things that have either already happened or that are happening right now. To be clear, nothing that I've said in any of these videos means that housing is going to suddenly become cheap or even affordable. Prices might come down, but most people are still going to need to borrow money to buy, and those mortgage payments are still going to be unaffordable. The real issue is that people who bought recently are seeing a very rapid increase in the cost of their debt and potentially a decrease in the price of their home. But as far as the mortgage goes, they're stuck owing the bank whatever they paid for the house, not whatever it's worth now. Anyway, I know this was another complicated and depressing video, but I have some good news. Bob Dylan is selling his big fancy estate in the UK, which means there's going to be another fun video coming soon. I also want to thank Sebastian, Mark, Joe, and Ahmed who recently signed up to support the channel, as well as everyone who signed up earlier. Thanks for watching, and do your best to enjoy the weekend.